And I'm going to close chapter 8 and go to chapter 9. Chapter 9 is about long-term liabilities. Chapter 8 was current liabilities, which is liabilities that you need to pay within 1 year of 1 year or your operating cycle, whichever is longer. Long-term liabilities, normally those are liabilities that you need to pay them, but the maturity will be longer than a year. So those are long-term note payables, mortgage payable, loan payable, those type of things. In order to get some idea about this, I like to do some problems, okay? Okay, so problem number, let's say 2. So it says the Tropical Paradise borrows $50,000 by agreeing to pay a 6% 6-year note with the bank. So the agreement is 6% interest rate, 6 years note. So it's a long-term liability, right? The fund will be used to purchase a new BMW for use in promoting resort properties. Loan payments are $828.64 due at the end of each month, with the first installment due on January 31st of 2021. Record the issues of installment note, payable, and first 2 monthly payments, okay? Here we go. I have some solutions for you. We can use that. So when you borrow, that means cash is coming in. You can use that borrowing for any reason, obviously. So cash is coming in, $50,000, and there's a note payable to recognize for that amount. That's a credit. So cash is debit, note payable credit. The first payment is January 31st of 2021. That means like 30 days later, right? So in 30 days, you have 1 out of 12 months interest to recognize. The interest is 6% and the principal is $50,000. So the first interest expense that you need to recognize is based on the $50,000 principal. So here is the $50,000 principal, 6% interest times 1 out of 12, that's $250. However, you are paying $828.64. So here is the plug-in. The plug-in is for the difference between interest expense and cash payment, which is $578.64. That is a reduction in the principal. So note payable will be reduced by $578. And because of that, the next payment in month 2, the principal is not $50,000 anymore. It is $50,000 minus the reduction on the principal on the first payment, which is $578. And then that will be multiplied by 6%, which is 0.06 times 1 out of 12. This time the interest expense will be smaller and the payment is the same, $828. Therefore, the note payable reduction on the principal will be a little bit higher. So each payment, your principal reduction will be higher, your interest expense will be lower as you go forward. Okay, let's do problem number 5. On number 5, it says, on June 1st of 2021, Florida National leased a building. Okay, June 1st. The lease agreement calls for Florida National to make lease payment of $3,618.18 each month for the next 2 years, with the first lease payment beginning June 30th, like 30 days later. The company's normal borrowing rate is 8%. Every company has a normal borrowing rate. Some companies, the borrowing rate is higher. Some companies, the borrowing rate is lower based on the credit history. So here it says for this company, the borrowing rate is 8%. Now, calculate the present value of the lease payment, round it to nearest whole dollar, use a financial calculator or Excel if you like, and record the lease on June 1st of 2021. Yeah, let's look at the solution on that. Let's see. So present value of lease payment is $3,618.18 payments for next 2 years, times a factor, which is 22 point, let's say 110544, and that will be present value of $80,000. So the present value of the lease payment today worth $80,000. Yes, I know you are paying $3,618 each month, but if you convert that $3,618 each month for the next 24 months, based on 8% rate, it will end up to be today $80,000 of present value of this lease payment. Make sense? So if you add all these $3,618 for 24 months, let me do it for you. So 3618.18 times 24. You see, the it shows on my calculator 86,836. But if you convert this to today's value based on 8% interest rate, it will become $80,000. Now you might say, okay, where is this 22.11 coming from? In order to do this, you have few ways to do it, like 3 ways at least. You can use the table, annuity table, present value of annuity table. You can use financial calculator, or you can use Excel. Okay, so if I want to show you the same thing on Excel, I have it ready here so you can see. You go to Excel and you enter N24. The payment is $3,618.18, and the interest rate is 8%. And you want to know what is the present value of this lease today. And in order to calculate that, you this is the formula, present value. But I want to do it again here so you can see what I'm doing. So here is the present value. I do one more time. So here is, you go to formulas, you go to financials, and you go all the way down to present value right there. Okay, and the rate is 8% divided by 12, which is for monthly, because the payment is monthly, so you have to convert the interest rate also to monthly. What is the monthly payment? Equals to 3,618. Sorry, no. What is the number of period? Is 24. What is payment? 3,618, right? And here you leave it blank, the type. What that means is, let me click here so you can read it. So when you click on the type, you make it either blank or 0 in order to show that the payment is ordinary annuity. Ordinary annuity means the payment is due at the end of each period, end of the month, end of the year. Make sense? End of each month. That's ordinary annuity. So you leave it either blank or zero. But if I say, no, this is the first payment is due right now, that's annuity due. Due right now means annuity due. That means the first payment is due at the beginning of the month. If that's the case, then you enter 1. Right? But because that's not the case, so you leave it either 0 or blank. Okay? And here you see already the answer is 7, almost 80,000, right? So click OK, and that's $80,000. Make sense? So that's how you do on Excel. You can also use financial calculator, obviously. So let's go back to, here is the here $80,000. So if you want to know what that is, I was trying to see if I can find this on the table, but it's hard because the interest rate is not an easy interest rate. Let's say if it was 12%, I would easily say 12%. Let me show you. I would easily say 12% divided by 1. 12% divided by 12, it will become 1 right here. And that is the present value table. So here is the present value of $1, no, but annuity. Here, present value of ordinary annuity. Remember I said ordinary annuity, that means the first payment is due at the end of the period. That's present value of ordinary annuity. We have present value of annuity due also. Annuity due, as I said one more time, it means the first payment is due right now. Annuity due, that means the first payment is due at the beginning of the period. But this is an ordinary annuity because the first payment is due at the end of the month. So if it was 12%, I could say, okay, 12% divided by 12 months, it's 1%. 1%, I go here 24 months, and the factor would be 21.24339, right? I would use that. But I cannot use that right now because the interest rate is not 12, interest rate is 8. And if I say 8 divided by 12, it will be an odd number that it's not in the table. That's why in this case, I cannot use the factor. But at least you can see where the factor is coming from, okay? You can see where the factor is coming from this type of table. Something like that. But in our scenario, we don't know what that factor is. So the easiest way is just to go to Excel and use Excel to find that. Since we know what the present value is, so you recognize the lease asset for $80,000, and then you recognize the lease payable for $80,000. Make sense? Okay. So what is this? This is a finance lease. Finance lease, that means is not operating lease. There's 2 types of lease that we have, operating lease and finance lease. The other name of finance lease is capital lease. If you rent a place on a monthly basis, then it's an operating lease. If you rent a car for a monthly basis, just like for 1 month, 2 months, 3 months, that's operating lease. All you recognize is rent expense. That's it. There is no asset to recognize. There is no liability to recognize. All you need to recognize is just rent expense debit, whatever payment is, and cash credit. But GAAP says if you have a lease that you are kind of obligated to keep that lease, and you cannot get rid of it because you don't like it anymore, moment you sign the lease, it's not an operating lease at that moment because you have to honor that lease all the way to the end. That becomes a finance lease or so-called capital lease. And in a finance lease or capital lease, you have to recognize the leased asset, whatever you equipment, machines, automobile, whatever you leased. That's $80,000 in this scenario. And then you recognize the lease liability, which is, we call it lease payable. And this way, GAAP says it's more clear to stakeholders like creditors, like investors, to see this obligation in your balance sheet, because your balance sheet will show a lease asset at the top, and also at the bottom in the liability section will show a lease payable, and that will provide some information to stakeholders that you have under such an obligation to keep this lease. And if they want to know how long this lease is, they have to go to notes of the financial statements to see, oh, this is a lease for, let's say, 24 months. That means up to 24 months, you cannot get rid of it. You cannot say, oh, I don't like it anymore. You have to pay this. It's an obligation. Okay. Let me know if you have a question, obviously. I like to go to another problem in your chapter 9 homework assignment. Chapter 9 is a little bit tricky chapter, so make sure you really study it hard, and it will be useful for many classes down the road if you take business or accounting courses later on. I like to do problem 6. Let's see, what is that? Okay, let's read this first. So remember, these tables are in your book at the end of your book. This is where I found it, at the bottom of your book. I go to future and present value tables at the bottom. So for a second, let's go back to chapter 9, exercise again, and read this problem number 6. Okay. It says on June 30th of 2021, Exploration Corporation signs a lease requiring quarterly payment each year for the next 5 years. So quarterly payments each year for the next 5 years. So it's a 5 years lease quarterly. Quarterly, that means 4 times a year. So 4 times a year times 5, that's 20. So N number of period, N is 20. Each of the two, oh, here it says already, okay? But I mean, I could have just calculated that myself, which I just did. Is $29,122.87 payment, okay? With the first lease payment beginning September 30th. So this is June, July, August, September 30th. Because it's 3 months, right? So July, August, September, 3 months gone, first payment is due. Another 3 months gone, the next payment is due, right? So the company normal borrowing rate is 6%. Again, every company has a different borrowing rate based on the credit history of the company. Here it says the hurdle rate, the borrowing rate is 6%. Okay, calculate the present value of the lease payment. Present value of the lease payment for, because you want to recognize the lease asset and lease liability, right? So you need to calculate what is the present value of all these payments. The payments are $29,000 every quarter for the next 20 quarters. But if you bring this payment, which is series of payment, that means annuity. And the next question is, what type of annuity we are looking at? This is annuity due, right? No, sorry, ordinary annuity. Why is ordinary annuity but not annuity due? Because in ordinary annuity, every payment, specifically the first payment, comes at the end of each quarter. So that's ordinary annuity. If the first payment was due today, it would be annuity due, but this is ordinary annuity. Series of same payments at the end of each period, ordinary annuity. Okay, calculate the present value rounded to nearest whole dollar, record the lease on June 30th of 2020. Okay, so here is the solution anyway. So present value of the lease payment, it says $29,000 quarterly payment times a factor, and that ends up to be $500,000 present value. Okay, the factor is this one is a round number and it's 4 times a year. So if I divide 6 by 4, it ends up to be 1.5 interest rate, 1.5% interest rate. Make sense? So I think I should be able to find this in the table. And N is 20 because we have N like 20. So let's go to the table and see where I can find these 17.16864, which is N20, I is 6 divided by 4, which is 1.5%. Okay, so let's go to the table. Here is the table. Okay, so we close chapter 9 for a second, go all the way down to present value tables here. And this is table number 1, which is future value. I don't need that. Table number 2 is present value of $1 one-time payment, but this is not one-time payment, right? This is series of payment. Series of payment, it means annuity, annuity, right? Series of payment. What type of annuity we are looking at? We are looking at ordinary annuity. So it's not one-time payment. Keep going. But I don't want future value. Keep going. Here we go. I want present value of ordinary annuity. Okay. So what is the interest rate? Interest rate is 6% divided by 4 times a year. That's 1.5%. 6 divided by 4. 1.5%. N is 20. So right there. That's your factor. 17.16864. That's your factor. And then you can multiply that factor by here, your payment, to get the present value of your payments in today's value based on 6% annual interest rate. It will become about $500,000. And now you can recognize the journal entry, which is lease asset per finance lease. Remember, I said in finance lease, you have to recognize the lease asset and lease liability. So lease asset is $500,000. That goes in the balance sheet asset section. And then lease liability goes in the liability section, which is lease payable, $500,000. So this will stay in your balance sheet at the moment, so people can see that you have such a lease asset and lease liabilities. Okay, and you can do the same thing in Excel also. So if you like to look at that, the same thing in Excel, you just again enter the information in here. You say the periods are 20 periods. The payment is, let's say, how much is it? I forgot, 20, whatever the payments are, like 29,000. Let me see. Do I have it? So it is 29,122 87. 29, 12287. Okay, so let's go back. 29, 12287. That's your payment, and the interest rate is 6%. Okay. So what is the present value of all this? Present value of all these payments today is, and then you go to formulas, financials, go to present value. And then rate is that, which is 6% in this case, divided by 4. Because it's quarterly payments, 4 times a year, so it's divided by 4. How many quarters? Equals to that, right? 20 quarters. Payments is that box, right? And just doing that, I'm gonna leave the type here, either 0 or blank. 0 or blank, that means annuity, ordinary annuity. And if I click here, you will see. Okay, 0 or blank means ordinary annuity. That means the payment comes at the end of each quarter. So you see the answer is right there, 500,000. So click OK, and that's 500,000. Make sense? So that's how you use Excel if you like to do that. Cool. Chapter, we did number 6. How about if I do one more? Let's say 8. Okay. So here I'm gonna go back to chapter 9, exercise. Problem 8. Okay, on January 1st of 2021, company issues 500,000, 9% bonds. Companies, they have 2 ways to raise capital. Either they issue stock or they borrow. The normal way that corporations, they like to borrow is issuing bond. They issue corporate bonds and they raise capital by form of equity financing. They might go also to a bank, borrow from that way, but that might be a little bit higher interest rate in some cases. So corporate bond will be a good option. So they issue $500,000 of corporate bond at 9% due in 20 years. So it's a 20 years long-term liability. With interest payable semi-annually. Normally bonds are interest paid semi-annually, most of the times. On June 30th and December 31st. So they are raising on January 1st. Every 6 months they pay interest for next 20 years, 9%. 9% divided by 2, that means 4.5%. Okay, 4.5%, and how many period? Because it's twice a year, so it's gonna be 40 year, 40 period, 20 times 2, 40 period. So N is 40, I is 4.5. Make sense? assuming the market interest rate on the issue date is 10%, the bond will issue at 457,102. Okay, wait a moment. Let me explain this a little bit. When they start thinking about preparing certificates for this bond, maybe at that moment, the interest rate is 9%. So they prepared the certificate. Down the road, 6 months later, all the paperwork are ready and they want to raise the capital by issuing bond. But right at that moment, they realize the interest rate is not 9% anymore. It is 10% for this type of company. They're not going to cancel all those paperwork. All they're going to do, they're going to say, okay, we're going to keep this paperwork. We're going to keep this certificate, but we will obviously pay 10%. So even though the bond is paying 9%, but actually the bond is always following the moment that the bond is getting issued. And at that moment is going to be 10%. So if you tell to your investors, listen, you deserve 10%, but I'm going to pay you 9%, no one will invest in that bond. It makes sense, right? Who's crazy to deserve 9%, but deserve 10%, but the company says, no, because my certificate shows 9%, I'm going to just do that. No. So in this case, the company will say, I'm going to honor this 10%. Even though every 6 months, I'm going to send you only 9%. But for the difference, I will give you a discount today, right now. At this moment, you invest less, a little bit, get a discount on your investment, and that will be so-called prepaid interest in advance because of that 1% difference. Make sense? So when I say what is for your calculation, what interest rate do you use? You always use the market interest rate for your present value calculation. Always. But when do you use this 9%? You use this 9% only one time at the beginning to calculate the semi-annual payment. Semi-annual payment will be based on 9%. Every other thing that you are going to calculate is based on the market. Got it? So what is the I for your calculation? I, interest rate. So your interest rate I is 10%, which is the market, divided by 2, which is 5. Good? Okay, assuming the market interest rate on the issue date is 10%, the bond will issue at 457,102. So the bond is issuing at what? 457. How much is the bond itself? 500. That means the investors invest today $457,000, but 20 years from now, they're gonna get their $500,000 back. You see, they get a discount today. And why do they get discount today? They get a discount today because the market interest rate is higher than bond interest rate, bond stated interest rate. Bond stated interest rate is 9%. Bond market rate is 10%. So market is higher, but the stated rate is 9%. So the issuer will offer a discount. Make sense? A discount in order to make it fair, in order to make sure that the bond in general, end of the day, is paying based on the market rate of 10%. Got it? So complete the first 3 rows of an amortization schedule. How to calculate this 457? This 457 is a result of 2 things. One, series of present value of series of payment. Present value of series of payment. What is the series of payment? Series of payment is 9% times 9% divided by 2, which is 4.5. 4.5% times 500,000 every 6 months. That's series of payment. Present value of that. The next thing is the $500,000 that they're going to receive in 20 years from now. You have to convert that into present value. So two present value conversion. Present value of the annuity using annuity table, ordinary annuity table, and then present value of $1 one time, which is $500,000 today. So two things needs to be converted to the present value, and then you add it together, it ends up to be 457,102. Okay, so complete the first 3 rows of an amortization schedule, record the bond issue on January 1st, and the first 2 semi-annual interest payment on January 30th, June 30th, and December 31st. Okay, so let's look at that first. We are doing number 8. So the bond is issued as at 457. So that's the face value of the bond at this moment, 457,102, right? And the stated rate says 9% divided by 2, which is 4.5. So 4.5% times 500,000, 4.5% times 500,000 is $22,500 every 6 months, no matter what. $22,500, which is 4.5% times 500. That's 22,500, no matter what. Okay, you know where that is coming. However, the interest expense actually is not based on 9%. The interest expense is based on market interest rate. Remember I said everything else is based on market? So only the payment will be calculated based on the stated rate. Everything else will be based on market. Okay, so the market is 10%, divided by 2 is 5. 5 times 457. 5 times 457. So carrying value 457 times 5%. The interest expense that the company is going to recognize is 22,855. But remember, the payment paid actually is 22,500, right? So what is the difference? 22,855 minus 22,500 is 355, right? 355. Now, you see this 457,102 on the carrying value, it has to go all the way down for 20 periods to become what? To become 500,000, right? It has to carrying value to become $500,000 after 20 periods in order to, 40 periods, I believe. In order 20 years, 40 periods. After that, 500,000 has to be at the end of this carrying value table, right? All the way down should be 500,000. That is the moment that the bond is due, is matured already, and has to be paid 500,000 to close the bond at the maturity. So this 557 needs to become 500. So this 355 needs to be added to this carrying value, and it becomes 457. Another time it will be added, and added and added and added all the way to become 500,000, which will be 20 years from now, 40 periods. Okay, in second 6 months, the payment is again always, based on the stated rate of 9% divided by 2 times 500,000, which is 22,500. But what is the interest expense? Interest expense is market interest rate, which is 10% divided by 2, times carrying value. Carrying value is 457, times 5% becomes 22,873. Interest expense will go up to 22,873 minus 22,500 becomes 373, and that's increasing in the carrying value. So 373 plus 457, the carrying value will add up to 457,830. And you do the same thing over and over and over in your Excel document for the next 40 periods, which is 20 years, and you end up to become at the bottom 500,000 carrying value, and that's the maturity, and that's the moment that the company pays back $500,000 to investors and close the bond payable. Now, for the first payment, remember the company is on January 1st. The company is recognizing that raised 457,102 from investors, but the bond that is going to be recognized is obviously $500,000. So the investors got 42,898 as a form of discount. 42,898 as a form of discount. Okay, but that discount needs to be amortized all the way down to 0. Got it? Discount needs to be amortized all the way down to 0. Okay. So the first payment comes up. The first payment then comes up, the interest expense is 22,855, that one, right? But the company is paying 22,500, right? So there's a difference. We call it plug-in. The plug-in here is 355, the difference of those two, 355. And that 355 is where you start to amortize the discount on bonds payable every 6 months, to the point that you amortize your discount all the way to 0, and you create your carrying value, convert your carrying value all the way to 500,000. So the carrying value keeps go up and up and up, and your discounts on bonds payable keeps going down and down and down. So the next 6 months, the second 6 months, the payment is obviously always same thing, 22,500 based on 9% divided by 2. However, your interest expense should be something different, which based on the schedule from your Excel, you will see the interest expense is 22,873. Since this is your interest expense, but you are paying only 22,500, the difference is a plug it in, which is the difference of those two numbers, which is 373, and that comes from here, as you see, and you are amortizing the discounts on bonds payable. So what is this discounts on bonds payable that you provide to your client at the beginning? As you see here, 42,000. What this discount is? This discount is a prepaid interest expense for the company and a prepaid interest income for investors. Because investors, instead of investing 500,000, they invest only 457. So they got already interest income right away on day one. Okay, which for investors, let's say IRS normally says, okay, if you got, let's say, discount on bonds payable, That's the interest that you receive in advance for your investment, right? And the company, based on GAAP, needs to amortize that, that interest expense. The company cannot say, oh, $42,898 that I gave it to as a discount to my client, to my bond investors, it's interest expense. GAAP says no, that's not interest expense today. That interest expense that you need to amortize it for the next 20 years and recognize a little bit more interest expense every time. So instead of recognizing $22,500 interest expense, the company recognized a little bit higher interest expense every time for the next 20 years. And that will make these discounts on bond payable all the way to zero. And the interest expense will be recognized a little bit higher every month proportionally. And that's much more fair and clear for investors, instead of recognition of a big interest expense on day one. That's not fair because this belongs to next 20 years. Make sense? Okay. Okay, so this chapter, I did a bond amortization table and bond journal entry in regards to, let's say, discounts on bonds payable for recognition of the bonds payable and the two payments. Hopefully this will provide enough warm up to get these problems done. You have a few more problems to do. I did already at least half of it. And I would like also you to read the chapter carefully. The book has a very good, simple example of a bond discount and bond recognition of journal entries and bond table amortization like this, or bond premium if there's a premium. The premium will be recognized if the company's bond is paying higher interest compared to market. The discount will be recognized if the bond is paying lower interest in compared to market. Okay. Let me know if you have a question. Have a good day for today.